What is the ISC 606 5-step revenue recognition model?
The 5-step model is 1. Identify the contract with the customer. 2. Identify the performance obligations. 3. Determine the transaction price. 4. Allocate the transaction price to the performance obligations. 5. Recognize revenue when or as each performance obligation is satisfied. This is one of the highest yield topics in FIR and BIR. If you get lost, return to those 5 steps.
What makes a contract valid under ISC 606?
A contract exists for revenue recognition purposes when the parties have approved the contract, each party's rights can be identified, payment terms can be identified. The contract has commercial substance. Collection is probable. If those criteria are not met, revenue usually cannot be recognized, yet under ISC 606.
What is a performance obligation?
A performance obligation is a promise to transfer to the customer a distinct good or service, or a series of distinct goods or services that are substantially the same and follow the same transfer pattern. A good or service is distinctive. The customer can benefit from it on its own or with other readily available resources, and it is separately identifiable from other promises in the contract. FIR simulations often test whether a bundle should be separated into multiple obligations or treated as one.
How is the transaction price determined under ISC 606?
The transaction price is the amount of consideration the entity expects to receive, adjusted for items such as variable consideration, significant financing component, non-cash consideration, consideration payable to a customer. Variable consideration is included only to the extent that it is probable a significant revenue reversal will not occur when the uncertainty is resolved.
When is revenue recognized over time rather than at a point in time?
Revenue is recognized over time if one of the following applies. The customer simultaneously receives and consumes benefits as the entity performs. The entity's performance creates or enhances an asset the customer controls as it is created. The asset has no alternative use to the entity, and the entity has an enforceable right to payment for performance completed to date. If none of these criteria are met, revenue is generally recognized at a point in time.
How are contract assets, contract liabilities, and receivables different?
A receivable exists when the entity has an unconditional right to consideration, subject only to passage of time. A contract asset exists when the entity has performed, but the right to payment is conditional on something other than time. A contract liability exists when the customer has paid or payment is due before the entity satisfies the performance obligation. This classification issue is heavily tested in modern revenue questions.
How are contract acquisition and fulfillment costs treated?
Incremental costs of obtaining a contract are capitalized if the entity expects to recover them, such as certain sales commissions. Fulfillment costs may be capitalized if they relate directly to a contract, generate or enhance resources that will be used to satisfy performance obligations, are expected to be recovered. Otherwise, such costs are expensed as incurred.
How do contributions differ from exchange transactions for not-for-profits?
A contribution is a non-reciprocal transfer, meaning the resource provider does not receive commensurate value in return. An exchange transaction is reciprocal, like a customer purchase. This distinction matters because contributions follow contribution guidance, while exchange transactions follow the revenue recognition model under ISC 606.
What is the difference between an operating lease and a finance lease for a lessee?
Both generally create a right-of-use asset and lease liability, but they differ in expense recognition. Finance lease expense is front-loaded because it reflects separate interest expense and amortization. Operating lease usually results in a more even single lease expense over time. Classification depends on criteria such as transfer of ownership, bargain purchase option, lease term relative to economic life, present value of payments relative to fair value, and whether the asset is specialized.
How is a lease liability initially measured?
The lease liability is initially measured at the present value of lease payments not yet paid, discounted using the rate implicit in the lease if readily determinable, or otherwise the lessee's incremental borrowing rate. Lease payments may include fixed payments, certain variable payments based on an index or rate, amounts probable under residual value guarantees, exercise price of a reasonably certain purchase option, and penalties for terminating when applicable.
What is special about sale-leaseback accounting?
In a sale-leaseback, the seller-lessee first determines whether the transfer of the asset qualifies as a sale. If it does, sale accounting is recognized and the leaseback is accounted for separately. If not, the transaction is generally treated as a financing arrangement rather than a true sale. CPA questions often test whether control transferred under revenue recognition principles.
What are deferred tax assets and deferred tax liabilities?
Deferred taxes arise from temporary differences between book basis and tax basis, as well as certain carry-forwards. Deferred tax liability, DTL, usually reflects taxable amounts in future periods. Deferred tax asset, DTI, usually reflects deductible amounts in future periods or future tax benefits such as NOL carry-forwards. The core formula is temporary difference times enacted future tax rate.
What is a valuation allowance for deferred tax assets?
A deferred tax asset is reduced by a valuation allowance if it is more likely than not that some portion or all of the DTI will not be realized. This is a high-yield judgment topic. Candidates should evaluate positive and negative evidence about future taxable income, reversal of taxable temporary differences, tax planning strategies, and carry-forward periods.
How are uncertain tax positions accounted for?
Uncertain tax positions are evaluated using a recognition and measurement approach. Broadly, a tax benefit is recognized only if it is more likely than not to be sustained on examination based on technical merits. The amount recognized is then measured based on the largest amount of tax benefit with sufficient likelihood of being realized. BIR may test this more than FIR, but the concept is fair game.
What is the fair value hierarchy under ISC 820?
The fair value hierarchy prioritizes valuation inputs into 3 levels. Level 1, quoted prices in active markets for identical assets or liabilities. Level 2, observable inputs other than quoted Level 1 prices. Level 3, unobservable inputs based on the entity's own assumptions. The hierarchy focuses on the inputs used, not the importance of the item itself.
What valuation approaches are used in fair value measurement?
The 3 broad approaches are: market approach, uses prices and market transactions for identical or comparable items. Income approach, converts future amounts to a present value amount. Cost approach, based on current replacement cost for the service capacity of an asset, the company should maximize observable inputs and minimize unobservable inputs.
How are subsequent events classified after year-end?
Subsequent events are generally classified as recognized/adjusting events, provide additional evidence about conditions that existed at the balance sheet date, so the statements are adjusted. Non-recognized/non-adjusting events relate to conditions that arose after the balance sheet date, so they are disclosed if material but not adjusted. Example: settlement of litigation that confirms a year-end obligation may be adjusting. A major fire after year-end is usually non-adjusting.
What is the difference between a change in accounting principle, a change in estimate, and correction of an error?
Change in accounting principle, usually accounted for retrospectively, unless impracticable or unless GAAP requires another treatment. Change in accounting estimate, accounted for prospectively in current and future periods. Correction of an error, prior period adjustment with restatement of prior statements when presented. Classic exam trap. A change in depreciation method is treated as a change in estimate affected by a change in principle, so it is handled prospectively.
How is a business combination accounted for under the acquisition method?
The acquisition method generally requires identifying the acquirer, determining the acquisition date, recognizing and measuring identifiable assets acquired and liabilities assumed at fair value, recognizing goodwill or a bargain purchase gain. Acquisition-related costs, such as legal and advisory fees, are generally expensed rather than included in the purchase price.
How is goodwill calculated in a business combination?
Goodwill is generally calculated as consideration transferred plus fair value of any non-controlling interest, plus fair value of any previously held interest fair value of identifiable net assets acquired. If this calculation is negative after reassessing measurements, a bargain purchase gain is recognized in earnings.
How is goodwill treated after acquisition?
Goodwill is not amortized. Instead, it is tested for impairment at the reporting unit level. If the carrying amount of the reporting unit exceeds its fair value, an impairment loss may be recognized. BIR may test goodwill impairment more deeply than FIR, including reporting unit concepts and triggering events.
What is derivative accounting trying to accomplish?
Derivatives are generally recognized on the balance sheet at fair value. The accounting then depends on whether the derivative is designated in a qualifying hedge relationship and what type of hedge it is. Without hedge accounting, gains and losses often go directly to earnings. With hedge accounting, timing of gain or loss recognition may be aligned with the hedged item.
What are the main types of hedges tested on the CPI exam?
The main hedge types are fair value hedge, hedges exposure to changes in fair value of a recognized asset, liability, or firm commitment. Cash flow hedge, hedges exposure to variability in expected future cash flows. Net investment hedge, hedges a foreign operation investment exposure. High yield point, effective cash flow hedge gains and losses are generally recorded in OCI first and later reclassified into earnings when the hedged cash flows affect earnings.
How are research and development costs usually treated?
Research and development costs are generally expensed as incurred, subject to limited exceptions. This is a favorite conceptual question because students often want to capitalize them. BIR may explore exceptions more deeply, especially where GIIP has specific software or other technical guidance.
What should a candidate know about pension and other post-retirement benefit basics?
At a high level, you should know the difference between defined contribution and defined benefit plans. In a defined contribution plan, the employer's obligation is generally limited to the contribution. In a defined benefit plan, accounting focuses on the projected benefit obligation, plan assets, funded status, pension expense components, and certain OCI items. BIR is more likely to test the technical details, but FIR candidates should know the basic framework.
What are the components of pension expense under a defined benefit plan?
Pension expense for a defined benefit plan under ISC 715 consists of 1. Service cost, present value of benefits earned by employees in the current period. 2. Interest cost, Increase in projected benefit obligation, PBO, due to passage of time. 3. Expected return on plan assets, reduces pension expense, subtracted. 4. Amortization of prior service cost, from OCI into expense over average remaining service life. 5. Amortization of net actuarial gain/loss, using the corridor approach or full recognition. Actuarial gains/losses and prior service costs are initially recorded in OCI and amortized into income over time.
What is the projected benefit obligation, PBO? And how does it differ from the accumulated benefit obligation, IBO?
PBO, present value of all future benefits earned to date, assuming future salary increases as applicable. This is the primary measure used in accounting for the funded status. IBO, present value of future benefits earned to date based on current salary levels, no future salary projection. The PBO is larger than the IBO for most plans with salary-linked benefits. The funded status reported on the balance sheet equals plan assets minus PBO. If plan assets PBO, a net pension liability is reported. If plan assets PBO, a net pension asset, subject to ceiling tests.
How is the funded status of a pension plan presented on the balance sheet?
Under ISC 715-20, the funded status, plan assets at fair value minus PBO, must be recognized as a net pension asset or liability on the balance sheet. There is no smoothing allowed on the balance sheet. Prior service costs, net actuarial gains/losses, and transition amounts not yet recognized in income are reported in accumulated other comprehensive income, IOCI. They are subsequently amortized from IOCI into pension expense.
What is an operating lease liability remeasurement event under ISC 842?
A lessee must remeasure its lease liability when there is a lease modification, a reassessment of the lease term, or a change in the likelihood of exercising a purchase option or variable lease payments based on an index/rate. The liability is recalculated at the revised discount rate and remaining payments. The ROU asset is adjusted by the same amount. If the ROU asset is reduced to zero but a liability remains, the difference is recognized as a gain. Remeasurement events are distinct from routine lease modifications that constitute a separate new lease.
How is deferred tax expense benefit calculated for a period?
Deferred tax expense/benefit equals change in deferred tax liabilities minus change in deferred tax assets, adjusted for the valuation allowance change. If a deferred tax liability increases, tax expense increases, future taxes expected. If a deferred tax asset increases, tax expense decreases, future deductions recognized. The total income tax expense equals current tax expense, taxes payable this year, plus deferred tax expense, benefit.
What temporary differences give rise to deferred tax liabilities?
A deferred tax liability, DTL, arises when taxable income will be higher than pre-tax income in a future period. That is, book income exceeds taxable income now due to timing. Common examples: accelerated depreciation for tax, MICRS, versus straight line for book. Installment sales recognized for book in full at sale, but for tax only as payments are received. Capitalized costs for book that are immediately deducted for tax. DTL tickets represent future taxes owed and are a liability on the balance sheet.
What temporary differences give rise to deferred tax assets?
A deferred tax asset, DTI, arises when taxable income will be lower than pre-tax income in a future period. That is, tax deductions will exceed book expenses in a future year. Common examples: estimated warranty liabilities accrued for book but deducted for tax only when paid. Bad debt allowance is a book deduction now. The specific write-off is the tax deduction. Net operating loss carryforwards, NOLs. Create a DTI equal to the NOL times tax rate. Advance payments taxed this year, but recognized in book income in a future period.
What is a valuation allowance, and when is it required for deferred tax assets?
A valuation allowance reduces a deferred tax asset to the amount more likely than not, 50%, to be realized. It is required when it is more likely than not that some or all of the DTI will not be realized. Factors evidence: history of losses, expiring carry-forward periods, book tax differences reversing at unfavorable times, and future taxable income projections. Establishing or increasing a valuation allowance increases income tax expense. Releasing it decreases tax expense, benefit.
How are uncertain tax positions, UTPs, recognized and measured under ISC 740-10?
A tax benefit from an uncertain position is recognized only if it is more likely than not, 50%. To be sustained on its technical merits upon examination, recognition threshold. If recognized, the benefit is measured as the largest amount, more than 50%, likely to be realized upon settlement. A cumulative probability approach. Unrecognized tax benefits are disclosed as a liability, UTB liability. Interest and penalties may be classified as income tax expense or operating expense per policy.
What is the intraperiod tax allocation, and how does it work?
Intraperiod allocation assigns income tax expense or benefit to the components of income in the same period, continuing operations, allocated income tax expense. OCI items. Tax effects remain in OCI. Each OCI component is shown net of tax or gross with separate tax disclosure. Discontinued operations. Tax effects allocated to that category, prior period adjustments, error corrections. Tax effects included in the adjustment to retained earnings. This ensures each section of the financial statements reflects its fair share of the tax burden.
What is the ISC 820 fair value definition and key concepts?
Under ISC 820, fair value is the exit price, the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. Key concepts: 1. It is market-based, not entity-specific. 2. Measured in the principal market or most advantageous market. 3. Assumes the highest and best use for non-financial assets. 4. A transaction is orderly, not a forced sale. Fair value is a current measurement regardless of when the asset was acquired.
What are the 3 levels of the fair value hierarchy, and what types of inputs are used?
Level 1. Quoted prices in active markets for identical assets/liabilities, most reliable. For example, NYSE stock prices for publicly traded equities. Level 2. Observable inputs other than Level 1 quoted prices. Quoted prices for similar assets, observable market data such as interest rates, yield curves, credit spreads, for example. Pricing a corporate bond from a benchmark yield. Level 3. Unobservable inputs using the entity's own assumptions about market participant assumptions. For example, private company DCF valuation, illiquid real estate. Highest subjectivity, most disclosures required.
What is the income approach, market approach, and cost approach for fair value measurement?
Income approach converts future amounts, cash flows, or earnings to a present value DCF analysis option pricing models, used for equity interests, intangibles, derivatives. Market approach uses prices and relevant information from market transactions involving identical or comparable assets/liabilities, comparable company multiples, comparable transactions. Cost approach. Current replacement cost reflects the amount required to replicate the service capacity of an asset. often used for specialized equipment or PP&E when market comparables don't exist.
What are subsequent events, and when is the financial statement issuance date relevant?
Subsequent events are events or transactions occurring after the balance sheet date, but before the financial statements are issued or available to be issued for non-SEC entities. Type I, recognized, provides additional evidence about conditions that existed at the balance sheet date, adjust financial statements. Type II, non-recognized, conditions that arose after the balance sheet date, only disclose, do not adjust. The cutoff date is issuance for public companies or available to be issued for private companies.
What are examples of Type I and Type II subsequent events?
Type I examples adjust the statements. Settlement of a lawsuit for an amount different from the accrual lawsuit existed at year-end. Bankruptcy of a major customer after year-end that reveals the receivable was uncollectible at year-end. Completion of an asset valuation confirming an impairment that existed at year-end. Type II examples disclose only new business combination completed after year-end, stock issuance or debt refinancing after year-end, natural disaster occurring after year-end, issuance of stock or bonds after year-end, new condition.
How is a change in accounting estimate handled prospectively?
A change in accounting estimate, for example, change in useful life, residual value, expected warranty claims, bad debt percentages, is handled prospectively, applied in the current period and future periods. No catch-up adjustment to prior periods is made, and comparative statements are not restated. Only the footnotes need to disclose the change if the effect is material. The one exception, a change in estimate that is inseparable from a change in accounting principle, for example, change in depreciation method, is treated as a change in principle reflected prospectively.
What disclosures are required for accounting changes and error corrections?
Change in accounting principle, retrospective. Nature of change, the reason it is preferable, cumulative, effect on beginning retained earnings, and the effect on each period presented. Change in accounting estimate. Description of the change and effect on income from continuing operations, net income, and EPS. Error correction, restatement. Nature of the error, the effect on each financial statement line for each prior period restated, and the effect on beginning retained earnings.
How is goodwill calculated in a step acquisition, acquiring additional shares of a subsidiary?
In a step acquisition, when an investor moves from equity method to consolidation by acquiring a controlling interest. 1. Remeasure the previously held equity interest to fair value at the acquisition date, recognizing a gain or loss in income. 2. Add the remeasured prior holding to the consideration transferred and the NCI fair value, then subtract the fair value of identifiable net assets acquired to get goodwill. This fresh start ensures all components of the business combination are at acquisition date fair value.
How is a gain on a bargain purchase disclosed and verified under ISC 805?
A bargain purchase, negative goodwill, occurs when the fair value of identifiable net assets acquired exceeds consideration paid plus NCI. Before recognizing the gain, perform a reassessment of all assets, liabilities, contingent liabilities, and NCI to ensure they are correctly identified and valued. If excess remains after reassessment, recognize a gain in income, not equity, on the acquisition date. Bargain purchases are rare. They may occur in distressed sales, forced divestitures, or government-mandated sales.
What is the measurement period in a business combination?
The measurement period under ISC 805 is up to 1 year after the acquisition date. During this period, the acquirer may retrospectively adjust provisional fair values assigned to assets and liabilities as new information is obtained about facts and circumstances existing at the acquisition date. Adjustments are made as if the accounting were complete at the acquisition date. That is, prior period comparative amounts are adjusted. After the measurement period closes, changes to fair values are recognized in current period income, not as measurement period adjustments.
How are transaction costs treated in a business combination under ISC 805?
Under ISC 805, acquisition-related transaction costs, investment banking fees, legal fees, due diligence costs are expensed as incurred in the period of the transaction. They are not included in the consideration transferred or capitalized as goodwill. Debt issuance costs for financing the acquisition are deferred and amortized per ISC 835. Equity issuance costs reduce the proceeds from the stock issuance charged to IPIC.
How does the acquisition method differ from the prior pooling of interests method?
The acquisition method, ISC 805, requires one party is identified as acquirer. All identifiable assets and liabilities are measured at acquisition date fair value. Goodwill is recognized for the excess over net fair value. Transaction costs are expensed. The former pooling of interests method, eliminated in 2001 by SFIS 141. Combined book values of both entities at historical cost, recognized no goodwill, and restated prior periods. It significantly understated combined assets and inflated post-combination ROI/ROE. FIR may test awareness that pooling is no longer permitted.
How is in-process research and development, IPR&D, treated in a business combination?
Under ISC 805, in-process R&D acquired in a business combination is recognized as an indefinite-lived intangible asset at fair value at the acquisition date, not immediately expensed. It is not amortized until the project is completed or abandoned. Once completed, it is reclassified as a finite-lived intangible and amortized over its useful life. If abandoned, it is written off to expense. This differs from internally generated R&D, which is expensed immediately.
What is a derivative financial instrument, and how is it defined under ISC 815?
Under ISC 815, a derivative has three characteristics. 1. Has one or more underlyings, for example, interest rate, stock price, commodity price, and one or more notional amounts or payment provisions. 2. Requires little or no initial net investment. 3. Can be settled by a net settlement mechanism or equivalent. Examples: interest rate swaps, currency forwards, futures contracts, purchased options. They are measured at fair value on the balance sheet each period, with changes in fair value flowing to income or OCI depending on hedge designation.
What is a fair value hedge, and how is it accounted for?
A fair value hedge hedges the exposure to changes in the fair value of a recognized asset, liability, or firm commitment. Both the derivative and the hedged item are adjusted to fair value. Gain/loss on the derivative, recognized in income immediately, offsetting gain/loss on the hedged item, basis adjustment, also recognized in income immediately. The gains/losses should largely offset in income. Common example: fixed-rate debt hedged with an interest rate swap converting it to floating rate, the swap's fair value and the debt's fair value change in opposite directions.
What is a cash flow hedge, and how are gains/losses reported?
A cash flow hedge hedges the variability in cash flows of a forecasted transaction or a recognized asset/liability's variable cash flows. Accounting: effective portion of the hedge gain/loss, reported in OCI, ineffective portion, reported immediately in income. When the hedge transaction affects income, reclassify the OCI amount into income in the same period. Example: A company that will purchase inventory in 6 months uses a commodity futures contract. The effective portion of the futures gain/loss is in OCI until the inventory purchase occurs.
What is a net investment hedge in foreign operations?
A net investment hedge protects against foreign currency translation risk on the net investment in a foreign subsidiary. The hedging instrument may be a derivative or a non-derivative, for example, foreign currency borrowing. Gains/losses on the hedging instrument, to the extent effective, are reported in OCI as translation adjustments alongside the cumulative translation adjustment of the foreign subsidiary. They are reclassified to income only when the subsidiary is sold or deconsolidated.
What are the hedge accounting documentation and effectiveness testing requirements?
To qualify for hedge accounting under ISC 815, an entity must 1. Formally designate and document the hedging relationship at inception, risk management objective, hedged. Item, hedging instrument, how effectiveness will be assessed. 2. Assess hedge effectiveness. The designated hedge must be expected to be highly effective, changes in fair value or cash flows attributable to the hedged risk offset substantially. A commonly used guideline is 80-125% offset. 3. Ongoing effectiveness assessment. Reassess each reporting period. Without meeting these requirements, the derivative is marked to fair value through income with no special hedge treatment.
How are foreign currency transaction gains and losses recognized?
When a U.S. company has a foreign currency transaction, for example, a sale denominated in euros, the receivable is initially recorded at the spot rate. At each balance sheet date, the monetary item is remeasured at the current spot rate. The resulting exchange gain or loss is recognized in net income, not OCI, for the period. When cash is collected, any remaining exchange difference is also recognized in income. This is the transaction gain/loss, distinct from the translation adjustment, OCI, for translating a foreign subsidiary.
What is the current rate method for translating foreign subsidiary financial statements?
Under ISC 830, when the functional currency of a foreign subsidiary is its local currency, the current rate method is used. Assets and liabilities translated at the current, closing, exchange rate. Income statement items translated at the weighted average rate for the period. Equity translated at historical rates. Retained earnings at accumulated historical rates. Translation adjustment, the plug to balance the translated statements. Reported in OCI, cumulative translation adjustment, CTI.
When is the temporal remeasurement method used for foreign currency translation?
The temporal remeasurement method is used when the functional currency of the foreign entity is the parent's reporting currency. For example, the subsidiary is just an extension of the parent's operations. Monetary items, cash, receivables, payables, remeasured at the current rate. Non-monetary items, inventory at cost, PP&E, remeasured at the historical rate. Remeasurement gains/losses flow through net income, not OCI. A highly inflationary economy, greater or equal to 100% inflation over 3 years, triggers the use of the parent's reporting currency as functional currency, requiring the temporal method.
What is revenue recognition for long-term service contracts under ISC 606?
ISC 606 requires evaluating whether performance is over time or at a point in time. For service contracts, performance is likely over time if the customer simultaneously receives and consumes benefits as the entity performs. An appropriate measure of progress must be selected. Output methods, milestones, units delivered, or input methods, costs incurred, labor hours. The measure must faithfully depict performance. If outcome cannot be measured reliably, Revenue is recognized only to the extent of costs incurred, break even.
How is variable consideration estimated under ISC 606?
Variable consideration, discounts, refunds, rebates, performance bonuses, penalties, must be estimated using either expected value method, probability-weighted amount across the range of outcomes, most likely amount, the single most likely outcome. The estimate is included in the transaction price only to the extent it is probable that a significant revenue reversal will not occur when uncertainty is resolved. Constraint. Volume discounts and returns are common exam applications.
What is the concept of a principal versus agent in revenue recognition?
Under ISC 606, a company is the principal if it controls the promised good/service before transfer to the customer. Recognize gross revenue, full amount. A company is the agent if it arranges for another party to provide the good/service. Recognize only the net fee or commission. The key test: does the entity control the specified good or service before it is transferred? Indicators include primary responsibility for fulfillment, inventory risk, and discretion to set prices.
How are contract costs, incremental costs of obtaining a contract, treated under ISC 606?
Incremental costs of obtaining a contract, for example, sales commissions that would not have been incurred without the contract, are recognized as an asset and amortized over the period the related goods/services are transferred. A practical expedient allows expensing if the amortization period would be 1 year or less. Costs to fulfill a contract are capitalized if directly related to the contract, generate/enhance resources used to satisfy performance obligations, and are expected to be recovered.
What is a bill and hold arrangement, and when is revenue recognized?
In a bill and hold arrangement, the customer is billed but the seller retains the goods. Revenue is recognized when control transfers, which may be before physical delivery if 1. The reason for the bill and hold is substantive, customer request with a business reason. 2. The product is identified as belonging to the customer. 3. The product is ready for transfer to the customer. 4. The company cannot redirect the product to another customer. All 4 criteria must be met. Otherwise, control has not transferred and revenue is deferred.
How are licenses of intellectual property recognized under ISC 606?
Licenses are classified as right to use functional IP, grants a license to IP as it exists at a point in time, revenue at a point in time, for example, software license for a specific version, film rights. Right to access, symbolic IP, provides access to IP as it evolves over time, for example, franchise rights. Brand name licenses, revenue recognized over time, the license period. The distinction depends on whether the licensor's ongoing activities significantly affect the utility of the IP. Royalties based on sales/usage are recognized when the subsequent sales/usage occurs.
What are warranties under ISC 606, and how are they classified?
Assurance-type warranty assures the customer the product meets specifications, not a separate performance obligation, accrue under ISC 460 as a contingency. The transaction price is not allocated to it. Service-type warranty provides a service that goes beyond mere assurance, for example, extended coverage 24/7. Support, treated as a separate performance obligation under ISC 606. A portion of the transaction price is allocated to it and recognized over the warranty period. Key indicator: if the customer could purchase the warranty separately, it is likely service type.
What are customer loyalty programs, points/rewards, and how are they accounted for under ISC 606?
Customer loyalty points represent a separate performance obligation, material right. A portion of the transaction price is allocated to the points based on their relative standalone selling price. Consideration times points standalone value divided by total standalone selling prices. The allocated amount is recognized in revenue when the points are redeemed or when they expire, if expiration is accounted for using a breakage estimate. This replaces the older incremental cost approach.
How is the right of return provision handled under ISC 606?
When customers have a right to return products, an entity should recognize revenue only the amount it is entitled to, net expected returns. That is, the transaction price, constrained by the estimated return rate, refund liability. For estimated returns, a liability for amounts expected to be refunded. Return asset, recoverable asset. The cost of goods expected to be returned, offset against COGS. The estimate uses the expected value or most likely amount method, subject to the constraint.
How is the concept of control central to revenue recognition and asset derecognition?
Control is the ability to direct the use of and obtain substantially all the remaining benefits from an asset. Under ISC 606, a seller recognizes revenue when control of the promised good or service transfers to the customer. Control transfer may occur at a point in time, delivery, acceptance, or over time, service contracts, custom assets. The same concept applies to asset sales. A gain/loss is recognized under ISC 610 only when control of the non-financial asset transfers. Applied broadly, control aligns revenue and derecognition accounting.
What is a constructive obligation, and how does it create a liability?
A constructive obligation arises from an entity's established pattern of past practice or published policies that create a valid expectation by others that the entity will act in a certain way, even without a legal requirement. Under GIIP, constructive obligations are recognized as liabilities when probable and measurable, similar to contingent liabilities. Example: a company with a consistent history of providing severance pays to laid-off employees has a constructive obligation to do so in a current restructuring, even without a formal plan announced.
What is a restructuring charge, and when is it recognized under GIIP?
Under ISC 420, costs related to an exit or disposal activity, restructuring, are recognized as a liability when the obligation is incurred, which typically requires, for involuntary termination benefits, a communicated, sufficiently detailed plan specifying terms. For one-time termination benefits communicated over a future service period, recognized ratably over that service period, for contract termination costs, when the contract is terminated. Restructuring charges cannot be recognized just because management approves a plan. Employee notification is required for severance.
What is the difference between a finance lease and an operating lease from the lessor's perspective?
Under ISC 842, a lessor classifies a lease as operating lease. Lessor keeps the asset on its books, recognizes lease income on a straight-line basis, and continues to depreciate the asset. Sales-type lease. Lessor derecognizes the asset, recognizes a net investment in the lease, and recognizes a selling profit at commencement, if any, plus interest income over the lease, direct financing lease. Lessor derecognizes the asset but does not recognize a selling profit at commencement, interest income recognized over the lease using the effective interest method. Classification depends on whether risks/rewards are transferred to the lessee.
How are unguaranteed residual values treated in a sales-type lease for the lessor?
In a sales-type lease, the lessor's net investment equals PV of future lease payments plus PV of the unguaranteed residual value discounted at the rate implicit in the lease. The unguaranteed residual value represents the portion of the asset's value not guaranteed by the lessee or a third party. It increases the net investment but does not affect the selling price or gross profit calculation. Changes in estimated residual value affect the net investment and interest income pattern. If revised,
How are tax effects of intra-period allocation applied to OCI items?
GAAP requires that the tax effects of items reported in OCI are also reported in OCI, not in tax expense from continuing operations. OCI items may be presented net of tax, show each OCI component after subtracting related taxes. Gross, show each OCI component pre-tax with a single total tax effect of OCI. FIR questions may show a pension adjustment or unrealized IFS gain and ask for the after-tax OCI amount. Multiply the pre-tax amount by 1 minus tax rate to get the net of tax OCI.
How are currency translation adjustments reported when a foreign subsidiary is sold?
The cumulative translation adjustment, CTI, accumulated in IOCI is reclassified into income when the entity disposes of a subsidiary, sale, liquidation, dissolution. This is a recycling of the OCI amount. The CTI is included in the determination of the gain or loss on sale/disposal of the subsidiary. If only a portion of the subsidiary is sold and consolidation continues, only a proportionate share of the CTI is reclassified or retained in IOCI, depending on the nature of the transaction.
How is a sale-leaseback transaction tested to determine if a sale has occurred?
Under ISC 842/606, a sale in a sale-leaseback occurs when the transfer of the asset meets the revenue recognition criteria of ISC 606. That is, control truly transfers to the buyer-lessor. If a repurchase option exists that the seller-lessee is reasonably certain to exercise, or if the leaseback is a finance lease, control may not have transferred. Treat as a financing arrangement, continue recognizing the asset, record a financial liability for the proceeds.
How are debt modifications and debt extinguishments distinguished under ISC 470?
Under ISC 470-50, a modification is an extinguishment if the present value of the new cash flows differs from the present value of the old cash flows by greater or equal to 10%, the 10% test. In that case, extinguishment, derecognize old debt, recognize new debt at fair value, record a gain or loss in income. Modification, no derecognition, adjust carrying value prospectively, spread remaining costs and fees over remaining term. Qualitative factors, for example, addition of equity conversion feature, may also trigger extinguishment treatment regardless of the 10% test.
What is an embedded derivative, and when must it be bifurcated?
An embedded derivative is a derivative instrument that is combined with a non-derivative host contract. For example, a convertible bond with an interest rate derivative. A structured note with a commodity-linked payment. Under ISC 815, the embedded derivative must be bifurcated and accounted for separately as a derivative, at fair value through income. If 1. The economic characteristics are not clearly and closely related to the host. 2. The hybrid instrument is not measured at fair value in its entirety with changes in income. 3. A separate instrument with the same terms would be a derivative.
How is the fair value option applied to financial instruments?
Under ISC 825, entities may elect the fair value option for most financial instruments at the instrument-by-instrument level at initial recognition, generally irrevocable. When elected, the instrument is carried at fair value with changes reported in income. This can simplify accounting for hybrid instruments, eliminating bifurcation. Reduce earnings volatility for matched assets/liabilities, or align U.S. GAAP treatment with IFRS. Unrealized gains/losses flow through income, not OCI, even for instruments that would otherwise be IFS securities.
What is the current expected credit loss, CECL, model, and how does it differ from the old incurred loss model?
CECL, ISC 326, requires recognizing an allowance for lifetime expected credit losses at origination of a financial asset, rather than waiting until a loss is probable, the old incurred loss standard. Key differences: timing, earlier recognition, day one allowance for new loans. Scope, current and future economic conditions considered, forward-looking, not just historical. Measurement, lifetime losses, not 12-month losses. CECL applies to loans, held-to-maturity securities, trade receivables, and other financial assets measured at amortized cost.
How are credit losses recognized for available for sale, IFS, securities under ISC 326?
For IFS debt securities under ISC 326-30, credit losses are recognized through an allowance, not a direct write-down. The process: 1. If the fair value amortized cost, evaluate whether the difference is credit-related. 2. The credit loss component, recognized in income through an allowance which can be reversed if conditions improve. 3. The non-credit component remains in OCI. Unlike the old OTTI model, credit losses on IFS securities can now be reversed in subsequent periods if credit conditions improve.
What is asset retirement obligation, IRO, accounting, and when is it triggered?
An IRO arises when an entity has a legal obligation to remove a long-lived asset at retirement. For example, decommissioning a nuclear plant, restoring a lease site, plugging oil wells per regulatory requirement. Recognition, record a liability at the present value of the estimated future retirement costs using a credit-adjusted risk-free rate, and capitalize an equal amount into the cost of the related asset. The liability accretes over time, the capitalized cost depreciates. Changes in estimated cash flows are recognized as adjustments to the IRO asset and liability.
How is an operating segment identified, and what is the role of the Chief Operating Decision Maker, CODM?
An operating segment is a component that 1. Engages in business activities earning revenues and incurring expenses. 2. Has operating results regularly reviewed by the CODM, Chief Operating Decision Maker, to allocate resources and assess performance. 3. Has discrete financial information available. The CODM may be the CEO, COO, or a committee. The management approach in ISC 280 means segments reflect how internal management views the business, not external product/service lines. The segments may not align with legal entities.
What is the accounting for insurance proceeds when an insured asset is destroyed?
When an insured asset is involuntarily converted, fire, flood, 1. Remove the asset, debit accumulated depreciation, debit loss, credit asset at cost. 2. Accrue insurance receivable when proceeds are probable and the amount is estimable, debit insurance, receivable, credit gain/loss adjustment. 3. When proceeds are received, debit cash, credit insurance receivable. The net gain or loss equals insurance proceeds minus carrying value of the asset destroyed. For tax purposes, certain involuntary conversions may allow deferral of gain if replacement property is acquired within specified time.
How is the completed contract method versus overtime recognition illustrated in a construction example?
Under overtime recognition, ISC 606, Using an input method, cost to cost, percent complete equals costs incurred to date divided by total estimated costs. Revenue recognized to date equals percent complete times total contract price. Revenue for the period equals revenue recognized to date minus revenue recognized in prior periods. If the contract is expected to result in a loss, the entire anticipated loss is recognized immediately in the period it becomes probable, regardless of the stage of completion.
How is a non-monetary exchange of assets accounted for?
Under ISC 845, non-monetary exchanges of assets are measured at fair value if the exchange has commercial substance, meaning the entity's future cash flows are expected to significantly change as a result. If commercial substance exists, record the received asset at fair value, derecognize the given asset at book value, and recognize any gain/loss. If no commercial substance or fair value is not determinable, record the received asset at the book value of the asset given up, no gain recognized. Losses may still be recognized.
How are contributed services recognized by not-for-profit entities?
Contributed services are recognized as revenue and expense if they 1. Create or enhance non-financial assets, for example, constructing a building, or 2. Require specialized skills that the NFP would otherwise need to purchase, for example, CPA services, legal services, nursing care. General volunteer services, for example, answering phones, that do not meet either criterion are not recognized. When recognized, the fair value of the services is recorded as contribution revenue and expense, or asset capitalization.
How is the effective interest rate computed for a bond, and how does it relate to yield to maturity?
The effective interest rate, also called the yield to maturity or market rate at issuance, is the rate that equates the bond's purchase price to the present value of all future cash flows, coupons plus face at maturity. For amortization under GIIP, this same rate is applied to the carrying value each period to compute interest expense. It is fixed at issuance for fixed-rate bonds under the effective interest method, unless the bond is fair valued or the rate is variable. The coupon stated. Rate determines cash payments, the market rate determines expense.
What is troubled debt restructuring, TDR, and how is it accounted for by the debtor?
A troubled debt restructuring occurs when a creditor, for economic or legal reasons related to the debtor's financial difficulties, grants a concession it would not otherwise consider, for example, reduced interest, extended term, forgiveness of principal, debtor accounting, ISC 470-60. If the total future undiscounted cash flows under the restructured terms greater or equal to carrying value of the debt, no gain, a new effective interest rate is computed. If total future undiscounted cash flows carrying value, recognize a gain on restructuring equal to the difference. The new carrying value equals total future undiscounted payments. Note, FISB eliminated TDR classification for creditors under ISU 2022-02, replaced with CECL guidance.
How is an installment sale recognized for book versus tax purposes?
For book purposes under ISC 606, revenue from an installment sale is generally recognized at the point control transfers, when the sale occurs, even though cash is collected in installments. For tax purposes, the installment method may be elected. Gain is recognized proportionally as payments are received, gross profit percentage times each payment. This creates a deferred tax liability because book income is recognized earlier than taxable income.
What is the accounting for investments in limited partnerships or funds, non-controlling?
Investments in limited partnerships, where the investor holds a minimal interest, are accounted for using the equity method if the investor has the ability to exercise significant influence. typically greater or equal to 35% threshold for LP-TICs, as opposed to the 20% threshold for corporations. If the investor cannot exercise significant influence over an LLC/LP, it may use the measurement alternative, cost less impairment, adjusted for observable price changes, or elect the fair value option. This is a nuanced area tested on BIR.
How is the tax benefit of a net operating loss, NOL, carry-forward recognized?
An NOL carry-forward creates a deferred tax asset equals NOL times applicable tax rate. Recognition requires judgment, record the full DTI. Then assess whether a valuation allowance is needed if realization is not more likely than not. Under TCJI 2017, federal NOL carry-forwards are indefinite, no expiration, but limited to 80% of taxable income in any future year. Carryback is generally eliminated, with exceptions. Exam questions ask how the DTI is measured and whether a valuation allowance applies.
How is the tax rate change applied to deferred tax balances?
When a new tax rate is enacted, not merely proposed, deferred tax assets and liabilities are remeasured at the new rate. The resulting adjustment flows through current period income tax expense or benefit from continuing operations in the period of enactment, even if the DTIs/DTL-TICs relate to prior periods. This is a frequent exam trap. The adjustment is made in the period of enactment, not in the period the new rate takes effect, which may be a future year.
What is the difference between current and deferred tax in ISC 740?
Under ISC 740, there is no longer a separation into current and non-current deferred tax items. ISU 2015-17 eliminated this for public companies. Private companies had an option. All deferred tax assets and liabilities are presented as non-current on the balance sheet. However, the conceptual distinction remains. Current tax expense, the tax payable or refundable on this year's taxable income, deferred tax expense/benefit, the change in deferred tax balances resulting from temporary differences, and rate changes.
How does IFRS differ from U.S. GAAP in the treatment of contingent liabilities?
Under U.S. GAAP ISC 450, a contingency is accrued when loss is probable and reasonably estimable, disclosed when reasonably possible. Under IFRS IIS 37, a provision, liability, is recognized when an obligation is more likely than not to require an outflow, 50% probability, and the amount can be reliably estimated. The best estimate of the expenditure is accrued using a probability-weighted approach for a range. Key difference: IFRS uses more likely than not everywhere. U.S. GAAP uses the higher probable threshold for accrual. IFRS may require accrual in some cases, where GAAP only requires disclosure.
What is the corridor approach for pension actuarial gains and losses, and has it changed?
The corridor approach, previously used under legacy GAAP, amortized actuarial gains/losses only to the extent they exceeded 10% of the greater of the PBO or plan assets, the corridor. Amounts within the corridor were not amortized. Under current ISC 715, the corridor approach is one permitted method for amortizing cumulative net actuarial gains/losses out of IOCI into pension expense. Entities may also recognize all actuarial gains/losses immediately in OCI with amortization, or use other systematic amortization methods. BIR tests the mechanics of the corridor amortization.
What is a hybrid financial instrument, and how is it accounted for under ISC 815?
A hybrid instrument is a non-derivative host contract combined with an embedded derivative. Examples include convertible bonds, structured notes with returns linked to a stock index, and callable CDTs. When the embedded derivative is bifurcated under ISC 815, the host contract continues under its own GIIP, for example, a debt host under ISC 470. The embedded derivative is recognized at fair value and changes flow through income. Alternatively, the entire hybrid may be elected under the fair value option, ISC 825, recognizing the whole instrument at fair value through income and eliminating bifurcation complexity.
How is the accounting for software development costs different under ISC 350 to 40 versus ISC 985 to 20?
ISC 350 to 40, internal use software, preliminary project stage, expense, application development, capitalized direct costs, post-implementation, expense. ISC 985 to 20, software to be sold/leased to others, pre-technological feasibility, expense as R&D, post-technological feasibility until product release, capitalize, post-release/general availability, expense ongoing maintenance/support. The key trigger for 985 to 20 capitalization is technological feasibility, a working model or equivalent. For 350 to 40, it is the application development stage, starting date.
What is the stock-based compensation expense calculation for stock options?
Under ISC 718, option compensation expense equals grant date fair value. For example, Black-Scholes value, times number of options expected to vest, recognized straight line over the requisite service period, typically the vesting period. At each period, cumulative expense recognized equals % of vesting period elapsed, times grant date fair value times options expected to vest. Forfeitures adjust the numerator, reduce estimated vesting. After the vesting period, no further expense is recognized regardless of market price changes.
How are restricted stock units, RSUs, measured and recognized compared to stock options?
RSUs are measured at the grant date fair value of the underlying stock, not an option pricing model. Since RSUs have intrinsic value equal to the share price on the grant date, no exercise price. Compensation expense equals grant date stock price times shares expected to vest, recognized over the service, vesting, period. RSUs deliver the stock or cash equivalent. Upon vesting, without any payment by the employee, they are simpler to value than options.
How is Employee Stock Purchase Plan, ESPP, compensation treated under ISC 718?
Under ISC 718, an ESPP is compensatory if it has a discount exceeding 5%, a looking back provision, or other features. Compensation expense is the fair value of the purchase, right, option-like value plus discount. Non-compensatory ESPP tickets, discount less or equal to 5%, no look-back, no option features, do not generate compensation expense. FIR and BIR may test the criteria distinguishing compensatory from non-compensatory ESPP tickets.
What is the accounting for a spin-off of a subsidiary?
In a spin-off, the parent distributes shares of a subsidiary to its own shareholders as a dividend, pro rata, no consideration received. The distribution is measured at the carrying value of the distributed shares, not fair value, since it is a reorganization of entities under common control. The subsidiary's net assets are removed from the parent's balance sheet. Retained earnings decrease by the carrying value. No gain or loss is recognized at the parent level. The spin-off is disclosed as a discontinued operation if it qualifies.
What is the accounting difference between an asset acquisition and a business combination?
Business combination, ISC 805. The acquired set of activities constitutes a business, inputs, processes, and outputs. All identifiable assets and liabilities are measured at fair value. Goodwill is recognized. Transaction costs are expensed. Asset acquisition, not a business. The purchase price, including transaction costs, is allocated to the acquired assets and assumed liabilities based on relative fair values. No goodwill is recognized. This distinction is critical in real estate transactions, where many deals are structured or accounted for as asset acquisitions. No goodwill, transaction costs capitalized.